Hey, what's good, self-direct investors? I hope you're all doing great, and I want to welcome you back to my channel. If you're new here, my name is Jordan. I'm the mind behind Make More Capital, and today we're coming at you with some MSO earnings and a midweek update from what we've seen this week in cannabis. So before we jump in, if you enjoy this video or you learn something, please just leave a like on it as it really helps out my channel. Then of course, if you want to learn how to take advantage of this generational investment opportunity, subscribe below so that you don't miss any future videos, but then there's plenty of content for you to go back and rewatch and educate yourself with. I've tried to put all the news and facts in one place so that you can learn about the industry and how it's evolved over time, and in doing so, you can identify some top companies that you keep seeing pop up that you think will be around for a while, and you can take advantage whenever you're ready. So we're going to go through Columbia Care's earnings, Verano's, and TerrAscend's. So we'll scroll to the bottom, and I'll probably spend the most time on Columbia Care just because they actually highlight every single state that they're in and the progress that they're making, plus the growth that they're seeing in those states. So it'll give us a bit of a comparison view for any other companies that we have invested in those markets that are not Columbia Care. But just wanted to point that out. We'll make our way back up. We'll start with their comprehensive income statement. So this is Q1 2021, Q1 2020 of last year. They did manage to bring in revenue of 86 million, up from 26 million. So that's 25 to 50 to 75, over 200% increase from 26. So that's healthy to see, although their production costs did increase from 18 million to 51 million as they are expanding and trying to get their systems down and ready in as many states as possible. So gross profit was 34.9 million with their fair value from what they grew in this quarter added 10 million. So gross profit of 45 million. And again, from last year, up from 8 million or 12 million is pretty good to see. Now, they did suffer a loss from operations of 2.4 million, and then after subtracting expenses and taxes, a net loss of 15.3 million. Mind you, quarter over quarter, subtract, an improvement from negative 18 million to negative 2 million, and it is still an improvement from 20 million to 15 million, or negative 9 cents a share to negative 5 cents a share. But again, as companies are expanding, main thing you want to see is that their revenue is increasing while they are cutting costs. But, they've got time because this is such a fast-growing industry. And on top of that, we can see their net loss, negative 15.3, but because they can add their fair value adjustments for what they've grown this quarter, it does pop them back up to a positive 9 million EBITDA. And they are sitting on more cash, which they raised, but we'll see that as we go up above. Now, one thing to highlight here, their 2021 outlook. So, anticipating for Q2, Q3, and Q4 on top of Q1 to bring in a combined revenue of 500 million to 530 million. They're expecting combined adjusted gross margins above 47%, which would allow them to bring in adjusted EBITDA of 95 to 105 million. And so if we just jump over to Columbia Care and see that this is their OTC ticker, so in US dollars trading at a market cap of $1.6 billion, and they're expecting to bring in $500 million, that's a price to sales ratio of just 3. And in my view, that's very, very cheap. But of course, if you want to compare this to other industries that are not treated like cannabis and that are looked at and valued, fairly, we see a lot of companies, especially in high growth sectors like tech, trading at price to sales of 20x or way more, especially when there's a lot of hype around them. So that is why I just do see a lot of potential, because Columbia Care is putting in the work to expand now and get into these key states. But just think of what they're going to be doing in the next 2, 3, 4 years once all of these states open up and they just keep supplying the demand. So anyways, just thinking out loud there, wanted to show that. Now we're going to go through the states. Virginia, first market cap to be EBITDA positive in the first quarter of revenue generation, and I believe Virginia allowed medical sales to start in July 1st of 2020. And then sales increased more than 50% each month of operations, average dispensary sales of 165 per basket. So again, this is just medical, not recreational. First harvest achieved in Q1, developing significant cultivation expansion plan to meet expected market demand with flower entering medical program. On track to expand Columbia Care retail footprint to 6 dispensaries and incremental cultivation and manufacturing capacity by year end. Personally, I don't see Virginia as being a big market, but obviously there's still 8 million people, and although rec won't open for a long time, it's good to get into these markets that others aren't in. In Pennsylvania, revenue momentum continues to accelerate, up 80% year over year. Increased operational hours in Q1 to drive revenue growth as weather and COVID restrictions impacted early months. Adding incremental Canopy, pending acquisition of G-Leaf to support 2022 growth opportunities and drive gross margin improvements. Top 5 market by combined revenue and adjusted EBITDA for Columbia Care in Q1 of 2021. Ohio, robust performance across both retail and wholesale, with same-store sales up more than 3 times year over year, and with wholesale relationships with more than 85% of dispensaries in the state. Commenced operations at manufacturing facility, which is now producing and selling finished goods. Their Canopy expansion expansion underway at existing cultivation facility expected to be completed by end of Q3 or mid Q4 2021, with first material harvest in early 2020. And in Ohio, they have a top 5 market by combined revenue and adjusted EBITDA in Q1 of 2021 as well. And we've got New York, which is just medical, not open for adult use yet. Revenue up 60% year over year, in part driven by wholesale and strong home delivery program. Gross margin softness reflected ongoing expansion projects in both cultivation and manufacturing. Acquisition of the Long Island cultivation facility, 1 million square feet roughly, offers the opportunity to scale with growing demand and potential for social equity partnerships. And again, with New York, you've got to think long term in the future, one of the biggest U.S. markets there is. Legislative approval of adult use sales and expansion of medical program, including flower sales, provides significant upside. As an existing registered organization, we will be able to add 4 incremental medical dispensaries and co-locate 3 adult use facilities for a total of 8. Up to New Jersey. Retail sales growth outperformed expectations year over year and doubled sequentially. Significant drag on overall gross margins due to accelerated development of cultivation and manufacturing fixed assets. So they actually seem to be doing a lot of expansion and construction in New Jersey, which is costing them money. First significant harvest from Legacy Vineland facility expected in Q3. 2 additional dispensaries to open in 2021, Deptford in Q2, and a third by year end to match expanded cultivation capacity, bringing total to the state maximum of 3. Both will be cannabis locations. Sorry if I didn't say that clearly. And second cultivation and production facility in Vineland, providing 250,000 square feet of canopy, manufacturing, and distribution space to support medical and adult use, is slated for commercialization in Q4. So a lot of construction going on in New Jersey, but again, they're preparing for a market that's going to open up adult use in 2022. Massachusetts sustained year-over-year revenue growth trajectory driven by earlier than expected contributions from wholesale revenue, partially offset by supply constraints. Adult use sales remain on track to begin late Q2 2021 at the co-located store in downtown Boston, the first Cannabis location in Massachusetts. Modest sequential gross margin decline in Q1 due to supply chain constraints. Ongoing construction and expansion activity at the Lowell cultivation and manufacturing facility in preparation for automated post-harvest equipment installations will result in increased capacity utilization and throughput beginning in late Q2. But again, a top 5 market with combined revenue and adjusted EBITDA in Q2 2021. And notice that these are all mature markets that have allowed adult use and medical for quite some time, at least where we're seeing one of these top 5 highlights. Illinois revenue up two times year over year, with continued robust retail sales performance and contribution from adult use sales, working to secure approval to open completed Chicago dispensary expansion, which would triple the size of current retail square footage. New product strains continue to drive foot traffic and generate positive reviews throughout the market, with automated machinery arriving in Q2 to drive Aurora facility utilization and reduce variable labor costs. Development of infrastructure for new product launches slowed margin gains due to absorption allocations, but are expected to accelerate in Q2 and second half of the year. Florida, with a few more left, Colorado, Arizona, and California, some of the more mature markets as well. But Florida, though, revenue up 58% sequentially in Q1 2021 and 3 times year over year, with significant same-store sales expansion due to dispensary-level supply chain improvements and flower availability. Implemented more efficient in-store processes, expanded product offerings, and updated dispensary websites across retail footprint. They restructured production planning process, or restructured production planning processes resulted in 61% quarterly improvement in cultivation yields. Gross margins increased more than 2,000 basis points quarter over quarter in Q1, or 2%. And commercialization at our Alachua greenhouse complex, initiated at the end of Q1, slowed gross margin improvement trendline. First harvest expected by end of Q2, providing significant scale to drive gross margin at accelerated pace in the second half of 2021. Now, Colorado revenue improved 27% year over year, and quarter one gross margins was 42%. Sequential results slowed in Q1 due to expected seasonality and decision to partake offline and upgrade largest indoor grow in preparation for 100 days of heat. Didn't know Colorado had such a thing. Interesting. During Q2 and Q3, leading to accelerated gross margins and EBITDA expansion in Q2 and second half of 2021. California, sequential revenue growth of nearly 3x with addition of acquisitions, increasing wholesale momentum through Q1. Experienced softness across market-wide retail and wholesale revenue related to COVID-19 restrictions in January, February, and early March, with noticeable uptick towards the end of the quarter. Began first phase of manufacturing project Cannabis finished goods out of DeSoto facility towards the end of Q1. Their gross margins increased 10 percentage points quarter over quarter, driven by accretive driven by accretive margins from Project Cannabis and THCSD. Again, another one of their top 5 by combined revenue and adjusted EBITDA in Q1 2021. And lastly, Arizona, to highlight, same-store sales increased approximately 70% from the same period last year, driven largely by the accelerated statewide rollout of adult use sales in January, expanding manufacturing in Tempe and upgrading cultivation facility in Chino Valley for additional wholesale and retail supply in second half of 2021, and continued focus on increasing gross margin above 54% in Q1 through new product offerings and supply chain management, inclusive of yield improvement, plant count, and wholesale agreements. So that's big. They were getting 54% gross margins in Q1 in Arizona alone. So obviously every single state probably provides a different gross margin percentage. So obviously the goal is to try and make sure that they're all as high as possible and balance them over time. But then as we can see here in their little snippet that they do make quite clean, nice to see quarter over quarter growth sequential from 10 to 15%. So again, if you think year over year, that's at least 60% there. But then we can see year over year, they managed to increase their revenue by 220%, their gross profit by 916%. So lots of growth here, which is good. And obviously I think it's better to do it now before safe passes or any of the latest legislative change comes. And Legacy Columbia Care same-store sales increased 60% year over year. So that's something worth noting. Recognizing the tremendous opportunity we have before us, we continue to deepen our state, regional, and national footprint by adding scale to capitalize on additional upside in rapidly expanding medical programs, and in particular in markets transitioning to adult use across the country. Significant strategic investments in markets such as New York, New Jersey, and Virginia will enable us to be the most efficient and scaled leaders in those markets and will cement our position as the industry leader on the East Coast. So good things out of Columbia Care. And also just wanted to mention here, they raised $140 million in Q1, so at least they already did raise. So any dilution is, should be accounted for in the share price, bolstering liquidity position in support for long-term growth initiatives. Ended Q1 with a cash balance of 176 for that reason. So well done, Columbia Care, showing the MSOs are very strong. Verano Holdings, they announced first quarter 2021 results, so we're going to jump down to the bottom because I just like to do it that way. Easiest for myself. Now, we can see their revenue. They brought in $143 million Q1 of 2021 compared to $66 million Q1 of 2020. So a nice increase there. Cost of sales did increase quite a bit though. Up was $15 million in 2020 Q1, up to $54 million in Q1 of 2021. But then as we can see here, gross profit before fair value adjustments based on any of the crops that they've harvested is $88.6 million. So for gross margin, $88.6 million of 143, which I believe will put them number 2 of all MSOs behind Curaleaf. But then if we look at what they did last year when they were a private company, gross margins of 76% seems incredible. And although I'm heavily invested in Cresco Labs, and I believe they're going to be the top wholesaler and continue to be, Verano seems to be following their approach in doing that, which helps increase gross margins. So clearly a good company worth looking into. Now on top of that, they did manage to but they harvested about $117 million worth of cannabis. So that can attribute to their total gross profit of $206 million. Now, I know this doesn't make a lot of sense, and in the last financial statement from Verano, I posed this question because I didn't understand it yet, but we will get to that in a moment, so it'll make sense in time, and it actually is going to make sense as to why Canadian companies are losing so much money now, and why the US is very different from Canada, but we'll get to that. So if we look at their expenses, total in SG&A for selling, administrative in general, $32 million, up a bit from $16 million, but again, the cost of expansion. So giving them an income from operations of $174 million. And then after subtracting all taxes, for positive net income of $125.5 million. And if we scroll down to their EBITDA, which is their earnings before interest, taxes, depreciation, or amortization, which is a profitability marker typically for companies that are using the IFRS accounting. Now, I want to point out that once these companies are allowed to uplist onto US exchanges, I don't believe they will use EBITDA. They would switch to the GAAP, which are the generally accepted accounting principles that US companies typically use. But again, because they can't uplist yet, they don't need to do that. Therefore, they're sticking to the IFRS type of accounting. And so their adjusted EBITDA is $192.4 million, but of course, you have to subtract what you harvested because you haven't sold any of that yet, giving them an EBITDA of $75 million, which is quite healthy, a little bit behind TrueLeaf at $90 million, which is the industry leader, but still very good. One thing I just want to point out, though, when I look at their balance sheet, as Verano is a newer company, and I've been focusing on the main MSOs, and again, I highlight Curaleaf, TrueLeaf, Green Thumb Industries, and Cresco Labs, just because I've watched them from 2018, 2019 to 2020. So at least for myself, I've seen them evolve over time, and they're not coming out of nowhere, or they're not necessarily doing anything shady, but just pointing out like intangible assets, 722,000, and goodwill, 222,000. These are typically assets that are worthless or would be written off. So if you do account for that in here, it removes a whole lot of the total assets that they claim to have. So that's something I just wanted to point out, just as, you know, someone that's learning through practice and trial and error of this. But a few highlights. Verano completed the acquisitions of Territory, Emerald, and Local Joint, all in Arizona, giving the company the third largest retail footprint in the state with 6 active storefronts plus 2 cultivation facilities. The company was upgraded to the OTC XQ Best Market, which is expected to increase visibility and improve liquidity for investors and marks another step towards maximizing long-term shareholder value. And in the first quarter of 2021, the company brought 4 new dispensaries online in as many states. Now, they also mention here that they've raised a good amount of money. I think the other one to highlight was that they did get an industry-leading 9.75% interest rate on a non-dilutive basis. Not industry-leading, but industry secondary behind Green Thumb's 7% interest rate. But yeah, so just to highlight here, like first quarter net income of 126 million, that's including the impact of their biological assets. So when you can't actually account for that with this IFRS type of accounting style, they would have had 8 million net income excluding the impact of biological assets. So just the way that they can move the numbers around, it does kind of allow them to make their adjusted EBITDA look really nice, which totally fair. Industry leading 52% margin. So, hey, that's fairly healthy, especially if that is, 75 million of 143 million in revenue that you're bringing in. And so if we take this first quarter revenue of 143 million and we round up to say just 150, a solid round number, we can anticipate that even if they don't grow at all, Q2, Q3, Q4, they could bring in upwards to like $600 million this year, but they're likely going to see some growth. So we can possibly round that up to 800 million. High end might be 900 million. And then if we jump over and look at their market cap, which values them on the over-the-counter markets at $2.5 billion. Again, let's say they were to do 800 million times 2, 1.6 billion, times 3, 2.4 billion, putting them at roughly a price to sales of 3 as well, which in my view is, again, very cheap. But that's it for Verano. And if we jump over to TerrAscend, reports their first quarter net sales USD of 53.4 million and adjusted EBITDA of 22.6 million. So same thing, we're just going to jump to the bottom so that we can look at the year-over-year comparison. Oh, that's their balance sheet. And you'll notice some companies have very nice financial statements that are very clear and easy to read through. Some are not as clear, and TerrAscend's is just one of the ugly ones that I don't necessarily like to go through. But if we look at their revenue, we compare Q1 2021 to Q1 2020, we need to look at their net sales after taxes. They brought in $53.3 million, up from $25.8 million, which represents more than 100% year-over-year growth, which you love to see in any growth company. It's pretty much expected from MSOs at this point, thankfully, because they have so much more people than Canadian LPs to sell to. Their cost of sales did increase as well to 18.4 million, up from 14.3 million. Now you love to see this though, it's only an increase of $4 million. That's it. Now, after all is said and done, growing more and then selling more inventory, gross profits of $37.4 million, up from $17.9 million, which is again an increase of more than 100% year over year. And then if we look at their total operating expenses, what it cost to operate, $22.2 million, up from $14.3 million. So just an increase of $8 million. Now, they did not manage a profitable quarter, this one, with a net loss of $12.7 million, up from $10.3, which they did suffer last quarter. But I know that TerrAscend is working on expanding into New Jersey and getting themselves ready in there. So it was a net loss of 8 cents a share, up from 7 cents a share compared to year over year. But I think to highlight, as they are working hard to expand, if we can see that their total operating expenses are only increasing by 8 million, and their cost of sales are only increasing by 4 million, while their revenue and gross profit, though, are increasing by over 100%, that is healthy for any growth company that you're looking into. So if we scroll up and take a look at their I know that they projected guidance as well, but this kind of just highlights it a little bit easier, and we can compare it quarter over quarter. So if we just compare to Q4 2020, quarter over quarter increase of 8%, year over year increase of 106%, as mentioned earlier. If we look at adjusted gross profit, what does this 3 mean? Adjusted gross profit and the respective margin are non-IFRS measures and are calculated before the impact from biological assets. I like that. I think that means that it's just from operations and not accounting for what they haven't sold yet, which I think is personally better. 34.9%, up from 29.7%, gross margins of 65%. So 65% of the net sales are adjusted gross profit, which you love to see out of any growth company. Now their SG&A, general administrative expenses, up 15.8 from 11.6, but again, just 30% of revenue. So a lot more is going to profit than what they're paying their employees and whatnot, which is nice to see. And they managed adjusted EBITDA of $22.6 million, up from $19.6, and this again accounts for 42% of the profit that they brought in. And then again, repeating their net income loss with a positive cash flow from operations of $13.3 million. So if we check out their operational highlights for the first quarter, they completed 80,000 square foot indoor cultivation and manufacturing facility in New Jersey. That's likely where a lot of the expenses went. They received a permit allowing for extraction, processing, and manufacturing in New Jersey, and they raised $175 million in an oversubscribed non-brokered private placement in January of 2021. So it seems like they're focusing a lot of their efforts into New Jersey to try and have a large foothold there and be one of the leaders, and they raised their full 2021 year guidance for net sales to exceed US dollars $300 million and adjusted EBITDA to exceed US dollars $128 million. Now, if we jump over to check out their share price at $11.30 on the over-the-counter market in USD, puts them at a market cap of $2 billion. Now, for a company that's expecting a run rate of $3 million for the whole year, and $128 million of that being profitable, that's great. But in my view, this does just make TerrAscend a little bit more expensive than some of the other companies, because if we look at 300 million, 600 million, 900 million, 1200 million, 15 billion, 1.5 billion, 1.8 billion, it puts them at a price to sales of just a little bit more. And so in that sense, you would just be buying them at a bit of a higher price. Maybe they have a bit more room to fall, over this next period of time as they're expanding. But I mean, ultimately, again, at a price to sales ratio of 6 compared to 3, they're still mostly just upside from here on out. So that's it for TerrAscend. Wanted to highlight all this. Now, this is an interesting article I found that explains biological assets in accounting and in cannabis, because this is something I didn't really know of. Now, this is from 2017, but it literally is in real time showcasing the rise in the Canadian cannabis industry, and it almost makes sense as to why these Canadian cannabis companies did look attractive at that time when they were not even able to supply the Canadian market, and how that did create a bubble, and why now these companies are losing billions of dollars in write-offs for inventory that they never ended up selling, and why I do think that the US case is going to be a lot different. So let me just jump into this. If the accounting regime that governs Canada's burgeoning cannabis industry seems a little hazy to you, you're not alone. Some publicly traded cannabis companies aren't entirely sure what to make of it either. Under international financial reporting standards, IFRS, cannabis producers must use an accounting practice unique to the agricultural sector that pre-books income for crops as they grow. So that accounts for the fair value of biological assets, which, I didn't know that before, but the more that you dig, the more you learn. The biological asset rules credits the value of product that is growing at fair value minus selling costs and reports that figure on the income statement. The changes in fair value are not counted as revenue, but as a reduction in the costs of sales, which as a result boosts the bottom line in your net income. This means a company can report net income in a quarter in which they grew or harvested cannabis but had no sales to speak of. So if you polled the LPs, almost every single one of them would say they prefer not to do it, says Maruf Raza, National Director of Public Companies at accounting firm MNP, who gave a presentation on how to navigate the complex agricultural accounting standards to some 30 licensed producers last month. A lot of these rules are actually creating an accounting burden on these LPs because they have to spend time to value the crops and to hire experts. But the potential for confusion, especially for retail investors, not to mention the danger that booked net income may never actually materialize, resulting in a future loss, has some calling on cannabis companies to take it upon themselves to be more transparent. Now, I have to set the stage as 3 of Canada's largest cannabis companies, Canopy, Growth, Aphria, and Aurora Cannabis. Now, at this point in time back then, this is literally what their ambitions were. Aurora Cannabis was aiming to grow 600,000 kilograms of cannabis. Canopy was aiming to grow 550,000 kilograms of cannabis, and Aphria was aiming to grow 255,000. So that's one of the reasons I chose Aphria. I thought Aurora and Canopy were just aiming way too high, out of this world. So for me, Aphria was like, that seems reasonable. They're actually going to hit that target. Neglected to point out the impact of biological assets in their press release highlights of their most recent quarters, though they did elaborate on those impacts in their management discussion and analysis document. If you know who this person is without having to see the name, then you've been investing for quite some time, likely since the Canadian cannabis market started, because this is Bruce Linton, the man that created Canopy. But so, for example, in 2017 at this time, in Canopy Growth Corp's most recent quarter, unrealized gains on the changes in the fair value of the company's biological assets amounted to $18.2 million, double its actual revenue of $9.8 million. That gain helped the company record its first ever quarterly net income of $3 million in the 3 months ended December 31st, 2016. CEO Canopy Bruce Linton said there's no benefit for a company in overstating the value of their biological assets because being too liberal with assumptions could lead to a future period with non-matching inventory, and markets don't take kindly to that. I thought IFRS was the craziest thing I had to learn about in great detail, but it actually is sensible. It creates a motive to be careful, as not to overstate, he said. You're incentivized as any reasonable party to try and be as conservative as you can, because if all the value you're reporting on your biological assets, the thing's growing, if it doesn't turn up in your inventory, you actually now have to do reverse accounting and say, oh wait, we didn't have all that. Another producer, Afria, highlights in its most recent MD&A that biological assets were worth $533,000, while the net effect of unrealized changes in the fair value of those assets amounted to $74,000 in the quarter ended November 30th, 2016. It explained that determining the fair value of these assets requires management to make a number of estimates, including the expected costs required to grow the cannabis up to the point of harvesting and selling costs, sales price, and expected yield for the plants. Now, Aurora touched on the impact of biological assets in its discussion of gross margin, where it explains how during a year ago, the company didn't generate any revenue from sales because they had not started, but recorded changes in the fair value biological asset of $2.2 million on the inventory it amassed. That's why it recorded a net loss of $2.7 million in the second quarter of 2017 when it was selling product, but a $600,000 gain in the year-ago period, it explained in its management discussion. Biological assets amount to tens of millions of dollars per quarter for a large expansion mode company like Canopy because they have so many plants growing, says Vahan Ajamian, an analyst at Beacon Securities. Eventually that's going to settle down, but for now the next probably several years everybody is in expansion mode and you'll probably see a lot of gains from there, and losses as the eventual bubble popped. The accounting practice carries a risk of having to write down inventory, and if the price per gram were to fall, or if the inventory was never sold at all, and that's exactly where Canopy and Aurora especially find themselves now. But given the Canadian government's plan to introduce legislation and to legalize recreational cannabis in the near future, Ajamian sees little risk that demand could suddenly dry up, unless the government only opens, or unless the provincial government in your most populated province of Ontario only opens 25 stores, so you cannot possibly supply the demand effectively. Damn, this did not age well. Everyone's going to have to increase by multiple fold, and it won't be enough by 2020 or 2019, and that's why they're all kind of in an arms race to try and gain capacity and get ready. The part of the problem is that legal cannabis is a new industry, they forgot an A there, that operates differently than the farmers the rules were intended to help. Raza said many feel trapped because they know they have to report according to international standards, but also realize there are criticisms levied at them for front-loading income. As for cannabis investors who might not be in the know about different types of reporting standards, Raza says there's only one solution: reading the company's financial statements in their entirety, as much as that might sound like a buzzkill. And so with all that said, I just want to highlight that the 2018 Canadian bubble makes so much sense now because Canada grew as much inventory as possible, but there was not enough stores or people to sell any of that to, which is why we're seeing these write-offs in the hundreds of millions and the billions. But that is why the US is going to be a different scenario, because they have 10 times the population with steady demand so far, while more markets to come. New York, 20 million people. New Jersey, 8 million people. Texas, eventually, 29 million people. Florida, huge for medical already. 21 million for recreational. Still to open in the coming years. So it's going to be a completely different story in my view. So I just wanted to go through that because it's kind of like traveling back in time. If you want to learn more about biological assets, this is a good resource, so I've left it down there below. And so this is the last earning I wanted to touch on. The parent company, which is partnered with Jay-Z, just wanted to highlight a few things I noticed in here as to why I would not invest in this company. So they did achieve consolidated net sales of 40 million, adjusted net sales of 46 million, but something to highlight right here, right off the bat. Gross profit for Q1 2021 was $7.2 million, or 18% of net sales. That is just too low, and if you want to keep growing at a fast pace and eventually become profitable, you cannot only have gross profit margins of 18%. Just wanted to add that in there. Now on to MSOs. Curaleaf to acquire Colorado-based Los Sueños. Transaction provides Curaleaf one of the largest outdoor cannabis cultivation facilities in the U.S. So they're happy to announce they signed a definitive document to acquire Los Sueños Farms and its related entities, the largest outdoor grow in Colorado. This will significantly expand Curaleaf's Colorado presence, vertically integrating in the state with large-scale outdoor cannabis cultivation. The total base consideration for the proposed acquisition is approximately $49 million for the operating company, and $18 million for the real estate and farm assets. Total consideration of $67 million to be paid 61% in voting shares, so a bit of dilution, 29% in cash at closing, and 10% in assumed debt maturing in 5 years. Now, main reason why they did this, Boris Jordan, executive chairman of Curaleaf, stated, "The acquisition of Los Sueños provides Curaleaf with outdoor cannabis cultivation expertise at commercial scale and establishes our foothold in the $2.2 billion Colorado market. This deal furthers our strategy of constructing low-cost supply chains that will secure healthy margins and position us for interstate commerce when it comes. Ultimately, their goal is to cultivate cannabis at less than $100 per pound, and this acquisition is a significant step in that right direction." So if they want to grow pounds that cheap, they need to have as much cultivation space as possible. So good move by Curaleaf in my eyes here. Now on to this interview with Columbia Care CEO Nick Vita. She asks about when legalization is going to come, and that seems to be the only question news anchors know. When's legalization going to come? These news anchors don't realize that these companies are executing and becoming nearly profitable in legal states, that federal legalization does not matter for what they're doing. All federal legalization does is help change the narrative around cannabis for the better and in a more positive light. Plus, it gives us investors the advantage because it will eventually allow these companies to uplist once SAFE passes too. So it's just funny how these news anchors are asking the same question over and over. But remember, it doesn't matter because these companies are already in legal states. It's just going to allow the expansion to accelerate.
So I wonder where we are in terms of your expectations about legalization federally. How important is it for something like that to happen? Especially, I believe you guys have a credit card deal, for instance, where the financial access for cannabis remains challenged because it's still illegal, federally speaking. So what are your expectations around any change in status under the Biden administration?
I think there's a lot of excitement about the possibility of changes. But we've always been a big fan of doing things in a way that's sustainable. So sometimes really sort of lofty aspirations need to be moderated by the realities of the complexity of the environment we're in. You have all these state programs with very successful track records, and then you have a lot of diversity and inclusion policies being incorporated into those programs. And so we've believed for a long time that cannabis can be an enormous contributor, both from jobs and tax revenue perspective. But what we're really hopeful that the federal government does is sort of think about the ecosystems that are being created to create an element of equity as well as economic opportunity that would be very hard to replicate if we took a very broad brush approach. So for us, sorry, go ahead.
No, please finish.
I was just going to say, so we actually think there will be incremental improvements sort of as the year goes on, and I think you're going to see an increased degree of adoption, but it could take any number of forms.
Right. And I was just going to ask, I think this is investors kind of thinking through this as well, valuing your company in the long run. Is it like a food products business? Is it like a technology business? Is it like a healthcare business? You seem to kind of straddle a lot of those worlds.
It's a great question. We grow like a technology business. We have margins like a steady business, like a healthcare business. But ultimately, we're an emerging market. And we're an emerging market in the most developed market in the world, right? We're in California, we're in New York, we're in Florida. And so watching our growth pattern is very different than taking the type of tail risk that one would normally associate or have to take with this type of growth.
Yeah, it's fascinating.
So think about what he's just said. We grow like tech companies with gross margins like healthcare companies in an emerging market in the largest cannabis market in the world, which is the United States, the richest country in the world. So whether politicians want to stay backwards and risk losing their re-elections, or whether people that live in states don't know this is happening and they don't want to do their own homework to find out that it's happening, that's their loss. And it makes me feel so privileged as an investor to get in before SAFE, before reform actually happens. But the point is that the perception of the plant based on lies and propaganda is all the way out here, and the reality of the plant is all the way out here. And if you study history at all, reality does not go out of whack without snapping back at some point, which gives me confidence that this is going to happen. And again, the longer it takes, the better for us. But this is a great interview with Curaleaf's Boris Jordan. It's a long one, but if you're invested in cannabis, it's worth watching. I'll put it in the link below. And this just encompasses that, yes, it's insanely ridiculous how the laws are, but for that reason, because they're so out of whack, they're going to have to be changed and amended at some point. So just watch this. Shout out to Kevin Carrillo for clipping this all just perfectly together.
Jim, it's incredible how difficult it is to operate in this sector. Not only everything you mentioned, you can't get a bank loan, young people that are working in the sector, operating on grow facilities or in laboratories are having their bank accounts closed. People making, $50,000 a year are having their Chase Manhattan or Citibank accounts closed because they're working in cannabis. This is the largest job creator in the United States at the moment, and we pay an effective tax rate of 55%. We are classified as more dangerous than cocaine under U.S. regulatory rules of the FDA and the DEA. So it's incredible that cannabis is still in that category at the federal level, but yet at the state levels, they're approving it, they're allowing more and more innovation in products, and the industry's turning profitable even in a situation where both hands are tied behind their back. We can't trade on U.S. exchanges. And Canadian cannabis companies, Jim, can trade on U.S. exchanges, and U.S. cannabis companies, the ones that actually hire U.S. employees that create jobs in the United States, invest in the United States, cannot trade on U.S. exchanges. It's an absolute travesty. I've never seen anything like this happen in the United States before, where our own businesses are discriminated against. Foreign companies, Colombian companies can trade in the U.S., European companies can trade in the U.S., Canadian companies doing cannabis can trade in the U.S., but U.S. companies that operate in our market cannot trade in the U.S. and cannot raise capital on U.S. exchanges from U.S. investors for our industry.
Yeah, to be against cannabis legalization is literally to be against the American principles they're founded on. So great highlight right there from Boris. Now, U.S. cannabis legalization update, SAFE Act gaining steam. So now this comes from Bank of America analyst Heather Balsky said Monday that significant steps in the cannabis legalization process may be just around the corner. Is the BWS bill dead in the water? At the same time, Democrats have their own Booker, Wyden, Schumer legalization bill that will likely be introduced to the Senate before June. Balsky said investors should be prepared for volatility in cannabis stocks if the bill is voted down, which appears likely at this point, based on commentary from the senators. That's really it. And I just want to point out that Bank of America, I'm pretty sure they're only initiating coverage on Canadian LPs, not US MSO. So they're not actually talking or working with any of the US MSO CEOs or any of the senators. So it just seems like based on commentary from what they've said already regarding the bill's inclusion of social justice and equity reforms, which are controversial among Republicans and some moderate Democrats, we are concerned it will not be able to get the 60 votes to pass the Senate. Balsky said, fair enough. We just wanted it introduced at this point. That's the next step. She said the BWS bill will likely need to run its course in the Senate before the SAFE Act gets a vote. Bazinga's take, cannabis stock investors shouldn't be too disappointed if the BWS cannabis bill gets voted down in the Senate, given that Balsky's commentary suggests the bill contains some controversial left-wing provisions that may not even appeal to some of the moderate Democrats. However, given that safe passage could come as soon as late 2021, so safe passage as soon as late 2021, that's a new potential deadline that we've been introduced to. Any potential sell-off in cannabis stocks following the BWS vote could be a buying opportunity. So hey, for the rest of this year, save up as much as you can, send that into your tax-friendly account or your brokerage account, and buy any dips, because this is the calm before the storm in my view. On to legislative changes. Montana governor signs cannabis legalization implementation bill. Congratulations, Montana. Governor Greg Gianforte on Tuesday signed House Bill 701, landmark legislation that implements and regulates the recreational cannabis program that voters approved in a ballot initiative last year, and funds a substance abuse prevention program that the new governor has championed since first days in office. So this bill has passed. And the under HB 701 retail sales of recreational cannabis for adults 21 and older will begin January of next year. Recreational pot will be taxed at 20%, while medical cannabis will retain a 5% tax. The bill also moves operation and regulation of the state's cannabis program from the Department of Public Health and Human Services to the Department of Revenue. So awesome job there, Montana. Good for you guys. Now, Minnesota lawmakers approved smokable medical cannabis as broader legalization stalls. So as we were expecting out of Minnesota, a bill to legalize cannabis in Minnesota that recently passed the House isn't advancing on the Republican-controlled Senate this session. But advocates scored a different kind of victory on Monday when it comes to expanding the state's medical cannabis program. That includes legalizing smokable forms of cannabis for registered patients. So this is just the kind of compromise that House Majority Leader Ryan Winkler, Democrat, sponsor of the broader legalization measure that moved through 12 committees before being cleared by the chamber, predicted would come about in the face of GOP resistance to the idea of ending prohibition altogether. So that effort wasn't all for nothing. Not much of a compromise though, but still incremental change is better than none at all. And obviously, incremental change is more likely than big all-of-a-sudden change, too. So, great small victory for the patients of Minnesota there. But sad news out of Louisiana. The bipartisan push to legalize recreational cannabis in Louisiana was killed in the House on Tuesday. So, though the bill is dead, it's clear that the idea of legalizing cannabis in Louisiana is becoming more popular on both sides of the aisle. So, residents of Louisiana should be quite disappointed in their politicians' efforts. However, more reason for you to pay attention who you're voting in next time to make this potential reality more likely sooner than later. Over to Canada, Canopy Growth to report fourth quarter and fiscal year 2021 results on June 1st, 2021, encompassing sales from January to March 31st, 2021. So will be interesting to see, as since Canopy can trade on U.S. exchanges, they typically in the past have led any sort of trend changes. So we'll see if this has any sort of effect on it. Now, another LP, Canadian cannabis producer HEXO, to enter U.S. with Colorado facility. HEXO Corp entered purchase and sale agreement for a 50,000 square foot cannabis production facility in northern Colorado, making a step forward for the Canadian producer's U.S. ambitions. Now, this will have nothing to do with being able to grow cannabis because they're not allowed, so it is just for drinks. The facility is zoned for production of a full range of cannabinoids and offers multiple operational capabilities, said HEXO, which is headquartered in Ottawa, Ontario. Yay, my hometown. It will provide HEXO with the necessary infrastructure to begin production and enable the company to continue expanding our joint venture with Molson Coors to create Trust CBD-infused beverages, while also creating the necessary capacity to support future non-beverage CPG partnerships, HEXO CEO Sebastian St. Louis said in a statement. Now, I just wanted to point this out. Do you think this is going to bring them any revenue in the near future? No. So sadly, for a company that's not profitable and that is losing money, this is not a great investment in my view, as you want to focus on building these drinks probably in the assets you already have, but obviously long-term with their partnership and with the fact that they have a joint venture with Molson Coors probably isn't going to ever let them go bankrupt. But just wanted to point out that they didn't offer details. However, their shelf prospectus dated May 7th describes the company's attempts to acquire and retrofit a facility in Colorado. So that disclosure document, HEXO expected to pay approximately $6 million to acquire the real estate and then $16.5 to $49.5 million in retrofitting and improvements. So it's not going to be without cost. And just on top of that, HEXO Corp to acquire 48 North Cannabis. They're buying another Canadian cannabis company valued at approximately $50 million on an enterprise value basis. So it seems like they've just spent $100 million to buy more real estate and assets that aren't going to make them money anytime soon, and then they've just spent $50 million to buy revenue from 48 North Cannabis Corp. So just a reason why I'm not invested in HEXO. But in other news, substituting cannabidiol for opioids and pain medications among individuals with fibromyalgia, an online survey. So this is great to see. This was just an interesting survey done. Again, a small sample, so not enough to really, we just need the funding for bigger scale studies, but the study population was 93.6% female and 95.1% Caucasian, with an average years of 55.5 years. So that's all white females. Yes, that's what it says. But I looked up for fibromyalgia. I don't know how to say it. Fibromyalgia, I think it's called. I looked it up, and apparently, though, it's more likely in women than men. 9 women per 1 man. So that's likely why they had that sample size. Just wanted to point that out for context. The majority reported substituting CBD products for medications, most commonly NSAIDs, opioids, gabapentinoids, and benzodiazepines. Most substituting participants reported decreasing or stopping using of these pain medications altogether. That's huge. The most common reasons for substitution were fewer side effects and better symptom management. Age, hemp products, past year use of cannabis, and higher somatic burden were all associated with substituting. Those who substituted reported larger improvements in health and pain than those who did not. Participants using CBD cannabis reported significantly more substitutions than any other group and larger improvements in health, pain, memory, and sleep than any other subgroup. And this widespread naturalistic substitution for pain medication suggests the need for more rigorous studies. Of course, yeah, we hear that all the time. But what does this tell us? This article shows that people with fibromyalgia are deliberately substituting CBD products for conventional pain medications despite the dearth or lack of evidence suggesting CBD products may be helpful for fibromyalgia, which is a pain disorder like anyway, look it up. I don't know enough to give a good explanation offhand. CBD medication sparring and therapeutic potential should be examined in more rigorous design studies. Yeah, we just need people with money to fund it. That's why I invest, so I can make money and hopefully I can use it for the better. But to highlight, 72% of participants with fibromyalgia substituted CBD for pain medications. 70% to 94% reported substitutions resulted in stopped or reduced use of medications. Participants substituted for harm reduction reasons, and that is what cannabis is about. So, last few things. Even Japanese government to ease prohibition of medical cannabis or of cannabis-derived medicines. So, small step again into changing the narrative, but this is big, even from very tightly regulated or strict Asian countries that are very opposed to drugs and very backwards in the ways that they view it. Following months of discussion, Japan's Ministry of Health, Labor and Welfare is set to approve the use of pharmaceuticals containing cannabis as an ingredient in Japan, according to public broadcaster NHK. The Japan legal system takes a particularly hardline stance against drugs, and even the possession of small amounts of cannabis is generally treated as a major crime. However, the following approval of cannabis-based medicines in many other nations, at the beginning of the year, the ministry formed a committee to discuss whether Japan should follow suit with the effectiveness of such medications in treating sufferers of refractory epilepsy and as pain suppressant for cancer patients. The allowance will require amendments to Japan's cannabis control law, which currently forbids the use and importation of such medicines. Lifting the prohibition would ostensibly also allow Japanese pharmaceutical makers with proper licensing to produce cannabis-based medications of their own. So very, again, small step, but big to come out of Japan. So as we kind of take the world tour in each of these episodes, we're seeing a lot more countries become cannabis friendly. And, the more this happens over time, the more that we're going to see the narrative change. And the last big thing, just to point out from Todd Harrison on Twitter, Syracuse University, classes begin June 28th, top 10 jobs in the cannabis industry. In the last 5 years, cannabis industry opportunities have grown massively. We've seen a 400% increase in legalization across the country, with hundreds of thousands of new jobs being created. And so, if this is anything of, a new economy or a new industry growing, once the schools start offering courses for it so that you can actually start learning to, occupy a role that's going to be in that industry for a very long time, you cannot not take the cannabis industry seriously. And if you're sleeping on the cannabis industry at this point, it's your loss, folks. So let me know what you think in the comments. Are you invested in Verano, Columbia Care, or TerrAscend, and are you happy with the earnings, or were you disappointed? Let me know what you think below, or about any other thing that we covered in this episode. But other than that, if you enjoyed this episode, please leave a like on it, as it really helps out my channel. Subscribe below if you don't want to miss any more episodes, and I will see you on Sunday for an episode of This Week in Cannabis News. Have a great day, everybody.